Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 124 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful to you in your long-term financial journey. Today, what we are going to be focusing on and talking about is bonds in your retirement account. And, I've talked about bonds a bit before, and we'll rehash a bit of what I've talked about previously. But I want you to understand how bonds can affect your retirement accounts, how bonds can affect the income that you earn in retirement, and how the investment choices that you decide on when you are going to retire or leading up to retirement can have a profound effect on the retirement life that you can live and the amount of money that you're going to have in your retirement accounts over the long term. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcasts, then just be sure to leave me a review and subscribe on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplementary materials to all of the things I'm putting out daily on the long form YouTube and podcast episodes. And then if you need somebody to help you walk through your financial life, somebody to help you to create a financial plan that is specific to you and that will work for you and your family, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, first and foremost, what is a bond? Well, a bond is the debt of a company or a government or a municipality, whatever it may be. Bonds are debt. And it's important to note that bonds are debt because it will make sense how bonds end up paying investors. So let's just think for a moment about if you are to take a car loan or a home loan, right? What happens? You sign up for this loan over a fixed amount of time. You agree on a certain interest rate with the bank or the lender or whomever you are borrowing from, right? And you pay them monthly payments systematically until it is paid off. And those payments are made up of principal and interest. Well, bonds aren't all that different from your typical debt setup. It is just, they're just slight little tweaks and little vernacular as far as the words that you use to talk about the interest being paid and things like that, that you should understand as you are investing in bonds, maybe even for the first time. And so if you invest in a bond, here's what happens. Let's say a company, let's say Apple is going to issue bonds, right? They need to raise money for something in their company, and so they issue bonds. And the United States government also issues bonds all the time. They issue treasury bills, treasury bonds, things of the like. And so that is the United States debt, right? Well, let's say Apple issues bonds and they issue a 4% coupon bond, and you can purchase it for $900 because most bonds are in denominations of $1,000. And so you buy this bond at $900, you will receive $40 a year in interest payments, okay? And how do I get to that $40? Well, it's a 4% coupon bond. And so you take 4% of the $1,000 face value bond, you get $40 a year. And typically that's going to be paid semi-annually. And so you get paid every 6 months, $20. And so you get paid $20 6 months from now, $20 6 months from then, and so on and so forth. And until the bond matures, so until the life of the bond is over, then you will continue to receive those interest payments. Now, when the bond finally reaches its maturity, what happens is you receive the full principal of the bond, the $1,000, even though you only paid $900 for it, and you receive your last coupon payment, your last interest payment. So what ended up happening was you made 4% interest on the $900 you invested, plus whatever the appreciation of $900 to $1,000 over the course of the bond would provide you in a percentage return as well. So why is this a large asset class that investors are very interested in? Well, one of the primary reasons is that investors want sure things. Investors want things that are predictable. They want things that are as safe as possible for the highest return possible. And bonds have historically been known to be safer or more stable than stocks. And why has this thought persisted? Why have we thought about bonds in this way? Because With stocks, there is no way to know exactly what your return will be over time. But with bonds, if you hold them to maturity, you will always know the return that you are promised, and you should receive that return. The only way you do not receive that return is if the company or the government or whomever you purchase the bond from cannot pay the bond, and they default on that bond, or they just go bankrupt and they can't pay you at all. And so basically with a bond, you're saying, I'm going to make this return unless the company goes bankrupt or unless the government defaults on its bonds, which is not as likely as, losing money on a stock over time simply because the, short-term performance wasn't as good or whatever it may be. But then the question arises, are bonds what you want to be investing in over the long term? And my short answer is probably not. And here's why. First of all, bonds are going to earn less than stocks. Historically, bonds have earned less than stocks. Stocks allow you for a lot of good long-term growth. And if you can put up with the short-term volatilities of the stock market, then you can end up gaining a lot more money just by being invested in stocks over bonds. That is a very straightforward and first level way of thinking of, maybe we shouldn't be investing in bonds primarily for our retirement. Now, another thought when it comes to bonds, and I want to expound on this quite a bit, is that bonds are what they call fixed income investments, meaning you are receiving some fixed income off of the bond. You are receiving that fixed interest payment over and over and over again over the life of the bond. And as you continue to receive this fixed income payment, then what happens over time? Well, the longer the maturity of that bond is, the more the value of that interest payment is going to be devalued by inflation. And we've talked a bit about inflation recently, and inflation will eat into your returns regardless of what you're invested in. But if you are invested in fixed income investments such as bonds, well, as you receive those interest payments, that, like in the example that I used previously, that $20 you're going to receive every 6 months is going to become worth less and less over the life of the bond. That first payment that you receive of $20 is going to be worth more in purchasing power in what it can purchase you than will be the last or any of the subsequent payments of $20 that you would receive. And this is a very, very big deal because in retirement, we plan on being in retirement for a fairly long period of time. So if you are invested in bonds extremely heavily while you are retired, and you don't have anything in your portfolio that is hedging against inflation, then what you can end up with is, these bonds that are paying you this fixed payment over time, and you're trying to live off of that, but that becoming less and less valuable to you over time. And that can be problematic, and that is a reason that maybe being super bond heavy is not smart over the long term. Another thing about bonds that is definitely worth noting, and that is something that we definitely need to keep in mind, especially in our current state, where we are currently in our country, where we are currently economically. Something we need to keep in mind is that bonds, their interest rates and their price run inverse to one another. Now, why would this be important to you? Well, especially if, let's say maybe you're not just holding bonds, individual bonds over time and taking the income off of those. Maybe that's not your primary focus. Maybe your primary focus is, I will invest in these bond funds and receive the increase in value of the bond funds over time, and then whatever income that they push off. Well, what ends up happening with interest rates and bonds, and right now we are at record low interest rates. Interest rates are as low as they have ever been. And what happens is that as interest rates rise, the price of bonds declines. And so what you will see, and this is just a statement of fact, not an opinion, is as interest rates do rise, the prices of the bonds that you hold will subsequently decline. Now, this is not as big a deal if you are taking a certain amount of income off of bonds over time, and everything is cool and you continue to take that income. But if you ever want to sell bonds, or you ever want to buy or sell bonds, or you want to buy a bond fund, then the value of your overall portfolio can be heavily impacted just simply by the interest rates and the prevailing interest rates in the economy at the time. And so that is a particular risk that you are taking on. Not to mention, bonds are seen as extremely safe instruments. And I do not disagree that, bonds will get paid, right? And there's a reason that they will offer less returns than stocks. And we'll get into that a little more here in a minute. But the thing with bonds is that they are still extremely volatile because they do ride on interest rates. Their prices do ride on interest rates. And so the value of bonds at a given point is going to be far more volatile than you would ever expect out of something that is seen as a safe investment. Now, the reason that when we look at bonds, they tend to have lower returns than stocks, all else equal, is that companies are trying to raise money via debt, right? They have raised money via bonds, and they are having to pay their bondholders. They are having to pay their creditors systematically over time. Well, in having to pay those creditors, they also need some way to pay those creditors. And what they try to do is try to use that money in order to perform at a higher rate than the rate they are paying those creditors or those bondholders. And so if companies are taking out bonds, you would expect their stocks to outperform their bonds because the stocks are based on the performance. The stocks are based on the returns, on the net income, on the earnings, on the revenues. And where are those revenues coming from? Where are those earnings coming from? They are coming from the investments that the company is making into itself. And where is the money coming from that they're using to invest in themselves? Well, some of it is undoubtedly coming from the debt of the company and from the bonds of the company. So that is important to note as well. And it is very, very important to keep in mind as we look at bonds in your retirement accounts. And let us also note that individuals are a couple of things: living longer and working longer than they ever have, okay? Individuals are living longer and working longer than they ever have. Retirement is not such a set thing as it used to be, or as maybe we still think of it as. Retirement is not just this set age at which, hey, I get to this point, I retire, I take my Social Security, I take my pension, I go home. Because pensions are going away. That that thought process that stuck around for a long time of, hey, I'll just work for 30 years, 40 years, I will, get my pension and go home, and that pension will cover me for the rest of my life. That really doesn't exist anymore in corporate America. I'm not saying it doesn't exist at all. I'm just saying on a wide scale, companies do not do this in the way that they used to. And this is important. And this is important when we talk about bonds, and it's important when we talk about investing for retirement. Because what that is forcing individual savers to do is to have more money prepared for retirement. We need more money in order to retire on, because now we don't have those guaranteed payments of the pension. And who knows how long we can, bank on Social Security being around and being well funded and being able to provide good, secure payments to individuals as well. And so, given that those things are, variables that are on the weaker side, especially the pension one, because those just really, really don't exist on a wide scale anymore, we have to save more. And in having to save more, you can do so in multiple ways. Well, one way is I can just save more money, right? I can just put more money away. And we talked about how putting more money away is the number one way in which you can have more money in your retirement accounts over time. And so that is obviously something you want to be doing. But in the same way, if I need to have more money in my retirement accounts when I am ready to retire, something I also need to do is be making good returns over time. It is going to not benefit me very much to take a super conservative approach and just sock money away into that conservative approach. We need to be accumulating as much as we can in our retirement accounts, especially our tax advantage retirement accounts, where we can grow tax-free or tax-deferred and grow our monies over time. And bonds are going to provide subpar returns to stocks. That is just the case. That has been the case over a long period of time, and my guess is it will continue to be the case over a long period of time. So what am I suggesting? I am suggesting that while you are working, that you keep a heavier stock portfolio, that you don't just dig into being invested in bonds and increasing your bond allocation systematically to a very high percentage of your portfolio by the time you retire. That is not likely to benefit you very much. You need to get the returns that you can while you're working, and you need to understand the stock market, understand the compounding of money over time, because we've talked about how the stock market over 10-year periods almost never has had negative outcomes over a 10-year period. And we've talked about the bond market also being extremely volatile in price as well. So if you're just looking at the value of your accounts over the long term, stocks are going to provide you better value. Now, none of this is me saying that bonds don't have their place. None of this is me saying that you should never invest in bonds. But what I am suggesting is that bond investing in your retirement account on a wide scale and doing it too early may not be a good idea. Now, what this idea of being more stock heavy or not as heavy in bonds is going to cause is it is going to cause you to have to deal with the fluctuations of the stock market. It is going to cause you to have to pay attention and have a cool head about the stock market. You can't just be looking and freaking out at the fact that things are volatile or that the price of stocks fell off the face of the earth last March or whatever it may be. You are going to have a cool head and understand that this is a long-term game. That is part of the reason that a bunch of people end up flocking to bonds in the first place, is because they have such a short-term risk-averse mindset and they don't understand the stock market very well. And so they'll just run to bonds or even run to cash because they do not know, because they do not understand, and they are not willing to keep their money in something that, and I wouldn't be willing to keep money in something I don't understand either, but they're not willing to keep their money in something that fluctuates like the stock market does fluctuate. And when it comes down to it, what do people want? People want guarantees. They want returns without the risk that goes along with the returns. And I've told you before that it just does not exist in the way that you would like it to. And so we have to keep in mind that since we want certain returns, since we want to make sure that we can get a certain amount of money in retirement, then we are going to have to put a lot of money away and make really good returns over time in order to do so. Now, if you are in retirement, and you want to know what your bond allocation maybe should be in your retirement accounts, you need to keep in mind the amount of money that you have saved, right? And so we've talked about withdrawal rates this week and how, if you end up needing 6 or 7% off of your retirement accounts, then it's going to be hard to find that on a bond portfolio that is going to be relatively safe. You're not going to have a good time finding 6 or 7% returns unless you are really, really stock heavy in retirement. And then in a similar way, if you just have a ton of money piled up and don't need a high withdrawal rate, then you can invest making less and less in the way of returns. But the thing that you must keep in mind, which I alluded to earlier and talked a bit about, is that inflation will eat into the value of your money if you are invested in fixed income instruments like bonds. Stocks will continue to grow with inflation and keep up and hedge against inflation over the long term, and bonds will, the fixed income aspect will get eaten away at by the inflation that you have. And so it is perfectly fine. Look, if you have a lot of money, if you have a fair amount of money to take care of you and your family, and you can invest in bonds that are going to pay you enough money, they're going to pay you enough in fixed payments in order to live your life over time. Look, I am proud of it. I'm happy for you. I'm perfectly content with you doing that. Look, I'm not saying that bonds are bad investment choices. They are good investment choices. It's just in what amounts and when can they be useful. The difficulty with them comes in the lack of returns. The difficulty in them comes in that they aren't that much less volatile than the stock market as people may think. The difficulty in them comes in that the fixed income aspect does get eaten away by inflation. That's where the difficulty comes in. But what you can do, right, as a retiree is you can just evaluate the amount of money that you have. And so again, if you have enough money to be able to invest in certain bonds that will pay you the income that you need over time, look, I'm perfectly happy with that. I'm not saying that you should never invest in them. Go right ahead. But you also want to keep in mind that the inflation factor, the value of your money, right? So having no stock allocation or no allocation of something that is going to hedge against inflation or grow over time is probably not a smart thing to do either. You should have something in the way of that in order to take care of the value of your money, the real purchasing power of your money over time. So that should be taken care of in some percentage, some way, shape, or form in retirement. And if you are worried about that, if you are worried about the inflation factor and still want to receive income, then you can always turn to good dividend paying stocks, right? There are a lot of stocks out there that pay, 2, 3, 4% dividends that are very, very safe dividends over the long term that you could invest in and receive a good amount of income back into your pocket while still hedging against inflation by investing in a company stock, which is going to grow with inflation because these companies do create the goods and services that we are using to determine the value of inflation by. And so that can be a good alternative as well. But like I said, if you can find the returns that you need in bonds and you understand what you're investing in bonds, I'm perfectly fine with it. But we just have to have the amount of money that we need in retirement. We have to have the amount of money that is necessary for our retirement accounts. And so if you're not able to do that, if you're not able to get to that point with just a bond portfolio or a bond heavy portfolio, then you may think about changing your allocations. And let us also not forget that the retirement accounts that we talk about, the 401ks, the 403bs, the IRAs, things of the like, they have tax advantages to them. And so any growth within those accounts is either going to be tax deferred if it is a pre-tax, traditional account, or it's going to be tax free if we are talking about an after-tax, tax-free growth account. And if it's going to be tax deferred or tax free, any growth that we have, then wouldn't you want the most growth possible, right? Wouldn't you want to get over on the IRS as much as possible in making the most that you can within those accounts and not having to pay them that money in taxes directly? That sounds like a really good deal to me, because otherwise, you may just be wasting your time investing in certain amounts of bonds that aren't returning well, just for the sake of safety or the sake of not being as volatile within those accounts. Now, a legitimate gripe here, a really legitimate gripe about IRAs, 401ks, 403bs when it comes to the tax advantages is if you are investing in things like municipal bonds within these types of accounts, because municipal bonds are tax exempt. And when you're talking about the tax exemption of bonds, then why would you put a tax exempt security, a tax exempt bond, into a tax advantaged account? That would make absolutely no sense. You shouldn't be investing in your retirement accounts with things like that. I'm not saying don't own municipal bonds in any way, shape, or form. Now, also, most people who own them don't understand them at all. So definitely understand what you're invested in. But if you are invested in municipal bonds within retirement accounts, then you are doing something that is unnecessary. You are making something tax-free that is already tax-free, or you're making something tax-deferred that is already tax-free. And so it really doesn't make a whole lot of sense to do that. So you see just another potential disadvantage that can come across. And I have seen it. I've seen it many times that people will do this, especially within things like IRAs. And so I just want you to keep that in mind as well, and take the most advantage of the growth opportunities that you can and the growth that you do not have to pay taxes on over time. And then lastly, let me get into the conversation of, should you ever own bonds then? I talk about all of these negatives and these downsides of owning bonds. Should you never own any bond allocation? Well, absolutely not. That is not what I'm saying at all. Now, a lot of this is going to have to do with your level of risk aversion, the risk profile that you have for yourself, the amount of risk that you are willing to take over time. A lot of it is going to be due to that. A lot of your decision is going to be due to your need, right? If you continue to need to grow your money, then you might have to take a more aggressive approach in your retirement accounts and not invest in bonds as heavily. it is ultimately just going to come down to what you are willing to do risk-wise in order to make your portfolio better or worse as far as returns, or make it safer or more risky, or more or less volatile over time. So that is what it all really comes down to when you're choosing whatever allocation you end up choosing. And I don't frown upon any particular allocation as long as it is what works for you and is what can provide you a good amount of retirement income moving forward and for the long term. Now, I am an individual who has no problem putting money in 100% stocks, and especially at my age. I'm young, right? I understand I can do that and do that for a long period of time, and that be perfectly acceptable. And I would suggest just based on the historical market returns and the outcomes that you continue to see over the long term, that a lot of you should probably take a similar route when it comes to at least beginning. When you are beginning, take the risk, invest in stocks, have the long-term viewpoint, and get that growth working for you. And I would also say, when you get to a point where you start thinking about bonds, you get into your 40s, your 50s, and get into this particular place where you're like, man, should I start adding a bond aspect, a security aspect, a less volatile aspect to my portfolio? Then I would definitely keep in mind, what do you need to get to? What is that retirement number that you are looking for? How much income do you project to need in retirement? And if you know what that is, and you can end up running some projections for yourself as to what your returns would be if you added 20% bonds to your portfolio, or 30% bonds to your portfolio, or whatever it may be. And there are mutual funds out there that will do this for you, and we've talked about these before, these target date funds. And I've told you what I think about target date funds, and you can go check out that episode that I had a while back. And these target date funds, all they do over time is they just pick some date in the future, and it is in the name of the fund. And they start out real heavy stock, and they work their way to being real heavy bond towards the end of the life of that particular fund. And this is a way in which you can slide your bond allocation more and more as you get older, but it's probably not what's going to benefit you the most. It's probably not what you exactly need given your risk profile and your level of risk aversion. So I want you to keep that in mind. I want you to keep in mind that you can increase your bond allocation over time. You can look into ways to get some fixed income. You can look into ways to decrease your level of risk in your portfolio over time. And it makes perfect sense. As your time horizon shortens, then maybe your level of risk should decrease in your portfolio. I totally get it. But it really comes down to you and what you think. Look, what I want you to take away from today is bonds are a legitimate investment tool. They are a legitimate type of security to invest in. You should keep them in mind over the long term, for sure. They have a lot of downsides, and they have a lot of things that if you don't understand what a bond does, you don't understand the relationship of bonds with companies and bonds with governments and bonds with interest rates, then you aren't going to really understand what's going on with your portfolio. So you should definitely understand them, right? And if you're going to invest in them within your retirement accounts, understand how that is going to affect your nest egg over the long term. Because I'm not saying that they aren't necessary. I'm not saying that they can't be used. I'm just saying that maybe the way in which a lot of people use them is absolutely not necessary. Maybe the way in which a lot of people use them is not the way they should be used. And so look at it on a case-by-case basis. Don't just try to fall into some particular category, into some particular mold that other people say you should fit in based on your age or based on where you want to get retirement-wise. Think for yourself. Think about where you want to be and the impact that a certain investment type can have on your long-term retirement outcomes. And just think about bonds and how they can impact your retirement. And maybe they can be perfectly good. I said this earlier. Maybe they can be perfectly good for you and your family and your situation. But maybe they are not what you need. Maybe you can't end up living long-term with a lot of bonds within your portfolio. So keep that in mind. Do the research for yourself. Look into the impact that bonds can have, and hopefully you can make the best decision for yourself and your investment allocation over time. Hey, thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcasts, then make sure to subscribe there and leave me a review. Follow me on social media at MNO with Dylan, and that's good supplementary materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And if you need somebody to help you walk through your financial life, somebody to help you create a financial plan and keep you accountable to that plan over the long term, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about risk aversion, and I talk about what your risk profile may look like, and I talk about how your risk profile should impact your investments. I talked a little bit about that today, but I really want to dive into it in tomorrow's episode. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.